Over the years, it has been proven that investing in shares is one way to realize long-term wealth. What is a share? Let's look at a simple example to illustrate how shares in a company work. A share is a part ownership of a company. When you buy a 10% share in a company, you own 10% of that company. This means that you also effectively share 10% of the company's assets, liabilities, and earnings. Each share has a rand value, which can be paid out in cash if you sell your shares. Companies sell shares in order to obtain funding and ultimately to achieve growth. In other words, companies may need money to start or expand a business. Let's look at an example. Let's say that Mr. X wants to start a business manufacturing soft drinks. Let's say that he needs 1 million rand to start this business. Borrowing money from a bank is not always an option. Mr. X might have 100,000 rand of his own capital, but he needs to raise the balance from other investors. So Mr. X sells shares in his soft drink factory to obtain enough money to start and build his business. He issues 1 million shares of 1 rand each to ensure that he has the 1 million rand needed to get going. By joining hands with private investors and allowing them to become part of this exciting business, he creates mutual benefit for himself as the entrepreneur as well as the investors. If you were one of the investors in the soft drink factory and you invested 100,000 rand for a 10% shareholding, 5 years later, if everything goes well, the soft drink factory could grow and double in value. As an example, let's say that the soft drink factory is worth 2 million rand after 5 years. This means that your 10% share that was worth 100,000 rand 5 years ago is now worth 200,000 rand. Just a reminder that all of the examples in this presentation are only for illustrative purposes, as actual results may vary according to many contributing factors. So, how does an investor aim to make money with shares? The basic principles are easy to understand. Investors try to buy a share when the share price offers value. Understand that shares generally need a growth period of several years in order to really grow in value. During the growth period, it is possible that the share price may underperform compared to other investments, even the money market. That is why it is important to be patient during the growth period. Invest in shares for the longer term and sell when one can realize the planned profits. The secret is to give it time to grow, 5 years or longer. Another important concept to understand is rand cost averaging. If you make a single lump sum investment, it is possible that the share price could be unexpectedly high on the day of the trade. Instead, by investing on a monthly basis, for example, you will be paying the average share price over time. Let's use an example to explain this concept better. Let's say we started investing in July 2011. Monthly contribution, 300 rand per month. Share price in July, 100 cents per share. Therefore, our 300 rand contribution can buy 300 shares. Total number of shares owned, 300. The average price paid per share is 100 cents. The value of our shares is 300 rand, and the total invested is 300 rand. In August, we contribute another 300 rand, but the share price has dropped to 93.5 cents. Because the share price came down, we can buy more shares. Shares purchased, 320. Now we own 620 shares. We have paid an average price of 96 cents per share. And our shares are worth 580 Rand. But we paid 600 Rand. In other words, our shares are worth 20 Rand less than what we paid for them. Let's now move on 4 months to December. Monthly contribution is still 300 Rand per month. Share price is 94 cents. Shares purchased 318. Between July and December, we bought a total of 1,966 shares at an average share price of 91 cents per share. The shares are worth 1,849 Rand. But our total contributions only amount to 1,800 Rand. To sum this up, when share prices go down, one can buy more shares for the same money. When share prices go up, one can buy fewer shares for the same money. But over time, one will pay the average price. And in the long term, one should realize a positive return. To benefit from Rand cost averaging, one has to invest for the medium to long term. Let's look at the potential returns of some real companies that you may recognize. If you invested 10,000 Rand in SAB Miller shares in 2007, 1 year later, they would have been worth 8,200 Rand. That equates to an 18% loss in the first year. If you invested 10,000 Rand into SPAR shares in 2008 and kept your shares for 7 years, your shares would have been worth 41,300 Rand in 2012. That's 22% growth per annum. If you invested 10,000 Rand in BHP Billiton shares at the beginning of 2003 and sold your shares at the end of 2012, you would have seen growth of 20% per annum. If you invested 10,000 Rand in MTN shares in 1998 and kept them for 15 years, they would have been worth 283,000 Rand in 2012, 25% growth per annum. If you invested 10,000 Rand in First Rand shares in 1993 and kept your shares for 20 years, your investment would have been worth 425,000 Rand in 2012, 21% growth per annum. According to these investment indicators, SAB Miller was running at a loss of 18% after 1 year. However, if the SAB Miller shares were kept for an additional 4 years, until 2012, 10,000 Rand would have been worth 19,500, having grown at an average of 14% per year over the 5 years. This is why equity investments are usually considered to be medium to long-term investments. Take note of the number of years that each investment was kept in this example. Take note of the average growth per annum for each company in this example. And take note that 10,000 Rand was invested in every case. Do you have 10,000 Rand or more to invest into shares? The truth is that there are very few people who have 10,000 Rand or more to invest. Previously, the opportunity to invest in shares was often limited to people with money. So, how can one buy shares? There are two ways. You can buy shares directly through a stockbroker. As an investor, you will need to find a stockbroker and open a trading account. You will pay certain monthly fees, even if you're not buying shares. You will need to have enough knowledge to make your own investment decisions. And you will need to have enough capital to invest in shares. Alternatively, you can buy shares in an investment company. This option is often more affordable. You don't need big lump sums of money. You don't need to have special knowledge or be an expert investor. And the risk is often less because the capital is usually spread better. Let us look at how an investment company operates. A group of investors can achieve more than a single investor. You could be part of the group. Each person invests what they can afford. And together there is more capital available to invest into the investment company. The investment company then uses this capital to invest into other companies, buying and selling shares in various companies on the JSE, as well as other investment instruments. Everything that the investment company does is for the benefit of its investors. This is how an investment company works. And this is how our investment product works.